When a government collects 10,000 million tax but spends 20,000 million, it inflicts a budget deficit of 10,000 million. To fill the deficit, it issues bonds worth 10,000 million. If a central bank has 10,000 million on its balance sheet previously, its purchase of the government bonds with new money will raise the balance to 20,000 million. Suppose by the end of the year, half of the government money flows to the public. The central bank's balance sheet will have 15,000 million on both sides. I have suppressed temporarily the entry of government bonds. If the government runs the same deficit in the second year, it needs another 10,000 million to fill the gap. But since the old debt is still outstanding, it must borrow altogether 20,000 million. When half of the borrowed money pays back to the creditor, namely the central bank, government obtains only 10,000 million. Hence, the central bank's balance sheet has 35,000 million on the asset side, but only 25,000 million on the liability side. The central bank's balance sheet is not balanced. Such imbalance has already existed in the previous table, or at the moment when the government has used up the borrowed money. The imbalance will exacerbate in the third year, and then in the fourth year, and so on. To cover the imbalance, some central banks create arbitrary entry. For example, the Federal Reserve creates an item called reserve balances. Alternatively, some other central banks chose to hide the imbalance by dropping the entry of government bonds completely from their balance sheet, as done, for example, here by Taiwan. And they don't need to invent any item either. The imbalance and the manipulations imply that government bonds are not central bank's assets. They also explain why most governments never bother to buy back the bonds or to repay their debt. However, while a government does not owe its central bank the money, it owes the money to its people.